Oh, stocks versus property, the great debate. Stay tuned.
I'm the ringleader, so listen up.
Billy Drury, the old man in a young man's body. How are you this morning?
Very well, thank you, Mr. Novak, the property-centric, passionate real estate agent.
Yes, most biased debate you're ever going to hear in real estate and the stock market versus the stock market. We're obviously going to be very pro real estate, but we're going to give you what we know and what we hear people on the street talking about, because a lot of people are juggling this. You know, do I do the stocks? Do I do the property? They're talking about returns on investment that they're getting in stocks versus property. They're talking about maintenance and repairs. What do you know, Bill?
It is, I reckon, the biggest debate. I see it a lot with first home buyers getting their $40,000, $50,000, $60,000 deposit together, and they get like this itch, a bit of a it's like burning a hole in their pocket, and they want to spend it and they want to invest it, and they feel like it's not doing anything, just sitting in the bank as cash. So they're looking at these stocks, shares, and getting ideas. And I see a huge amount with quite seasoned investors as well, at open homes, and they're sort of calculating the yields, and they're calculating what they can get out of the bank, and calculating what they can put into stocks and shares. And it becomes a big debate, like what the best approach is.
Well, I had a family member talking to me about a 14% return they were getting annually from their accountant. And I was like, they're like, property can't do that. There's no way property can do that. And I was like, tell me more about the 14% return and how that's wired, because I think the main thing that I'd like to bring up today in the stock versus property chat is the bank's attitude, opinion, lending policies with stocks versus property. I think you become a bit of a, and it's called compounding. So basically, for every dollar you have, well, let me put it this way: for every $100,000 you have with property, the bank is going to be prepared to give you 500,000, if my maths is right. So what does that mean? Sorry, 400,000. So what does that mean? What that means is that you're going to put in a portion of money. The bank's going to put in a portion of money. That's called compounding. Now, sorry, that's not called compounding. That's called leveraging. But the difference there is the bank doesn't want the extra rent on what they're going to lend you, and the bank doesn't want the capital growth on what they're going to lend you. So what that actually means is you get to enjoy the capital growth on the money that they're lending. So you're putting in 100, but you're enjoying 500 worth of capital growth, and you're putting in 100, but you're enjoying 500K being rented, and you get that upshot. Now, with stocks, it's different.
It is, yeah. You've got, dividends as a stream of income, but it is different. I was curious to actually know what the returns have been, and then work backwards from there. So, done a little bit of research.
It's not fair to look at the returns only, Billy, because because when you're looking at property, your actual returns, you're actually putting in a fraction of the money. So for stocks, to give you an example, residential properties don't get a margin call. So when you have if you've lent money on a stock, you can get a tap on the shoulder from the bank saying, hey, the stock value has changed, and we need you to top up. Now, if you can't top up to the level that the stock value has changed, they can call in, and that's called they can call in their margin. That's called a margin call. So with property, if the value of the property, which it generally doesn't, but if the value of the property changes, so if the property value goes from 500 to 400, you don't get a tap on the shoulder with residential property. You don't get a tap on the shoulder. So once you've got your 25-year loan, you generally set and forget. You can get margin called with stocks if you're borrowing money on stocks.
Interesting. Curious to know what the 5-year growth rate looks like. Here it is. ASX 200 performance from 2020 till now. So had a quick look. I'm no mathematician or big follower of the ASX, but here's what the research says. The ASX 200 dropped 30% in March 2020 due to COVID-19, but rebounded 88.2% to a record high in February 2025 this year. Even after the recent market corrections, the ASX 200 is still up 71.4% over 5 years. However, timing matters. Buying before the crash would result in just an 8.6% returns over the same period. What I'm seeing there is maybe timing matters for the ASX more than time in the property market, as in not timing the market, but time in time-wise. That's the Australian property market 5 years. Pretty cool numbers. For the property market, since March 2022, national property prices have risen 46.7%. Top performing cities, Adelaide, Perth and Brisbane. Sydney and Melbourne, slightly further behind, but Sydney, 38.6%, 5 years. There you go.
Well, so that was a 5-year graph you were showing with the stocks.
ASX 200 performance.
5 years?
Yeah.
It's killed it. It's killed property.
It's interesting, isn't it?
It's interesting. Now, bear in mind, it goes back to that the conversation I had with a relative about the 14% return on their money, what they were getting. I just want you guys to keep in mind leveraging your money in property is widely accepted by the banks. And basically when it comes to, so for every dollar you can borrow $4 or $5. It's a loan value ratio. Stocks, you're not going to get that leverage, and if you do get any leverage, say if you're at a 50% LVR or 30% LVR or something with stocks, they are you obviously there's a risk of margin calling on stuff like that as well. So I think you've got to be a little bit more careful. Why do people traditionally like buying a property over a stock, Bill, in your opinion?
My opinion, I'm glad you asked because I've got a great answer. In my opinion, it's tangible value. You hold it, you see it, you drive past it, you can move into it. It's tangible value. It's not numbers going up and down on a screen. And I think there's an element of familiarity with that, and that makes people feel good.
Okay. Look, one I like there is if you're living in there, there's no tax. So it's one of the only assets, I think the only asset in the country where you don't have to pay tax on. So if you move into your $500,000 apartment and that apartment turns to $700,000 and you sell it, you can put all of that money in your pocket. Whereas with stocks, you're going to have to pay the pipe up, pay the tax man. So the nice thing with Australian property, if it's owner-occupied stock, is no tax. No capital gains tax on the profits.
Yeah, I can see the draw cards for both. I really can. I think it's great, that stocks maybe has an entry-level price point much more achievable. I think that's why a lot of people would go down that route.
Yeah.
At the end of the day, from what the research says, Australians are doing a bit of both. They're doing a bit of both.
Yeah, I like that seed capital. Like you can actually get in at a much lower rate and enjoy the same amount of growth, whether you're putting in 10,000 or 100,000 when it comes to stocks. That's exciting. The barrier of entry for property is much harder, and probably the transactional costs with property are probably greater. It's easy to dip in and dip out of a stock, but it's much harder to dip in and dip out of a property cost wise.
Yeah, and the numbers here today, that's not a particular stock, that's just the market itself. So
Pretty impressive.
There you go. Hope that helps.
Property versus stock. There's some ones there. Billy, thank you very much. Have a great day.
Yeah, you too.
All right, cheers, bud. Thanks, everyone. Have a great day.
See ya.